Good afternoon, everyone. Thank you all for joining us for Valuing a Closely Held Business, Part 2, Income Approach Valuation Adjustments Double Dipping. My name is Samantha Brennan, and I'll be your moderator for today. This webinar is going to run for about 1 hour. If you have any questions, please drop them in the Q&A box and we'll address them as time allows. Before we begin, I'd like to introduce our speakers. Our first speaker is David Grelnick. He is a partner here at KLG. David has worked extensively with closely held companies, attorneys, accountants, and financial professionals on business valuations, investigative accounting, enhanced earning calculations, and damage claims. His background includes litigation consulting, forensic accounting, auditing, and taxation. Joining David today is Maida Kramer, a senior associate here at KLG. Maida assists closely held companies, attorneys, accountants, and other financial professionals with engagements relating to business valuation, enhanced earning calculations, and shareholder disputes. In addition, she has performed investigative and forensic accounting and financial asset tracing analyses. Now I'm just going to quickly go through our disclaimer. This presentation is for informational purposes only and does not provide legal, accounting, valuation, or tax advice. The views expressed do not necessarily reflect those of KLG. Any examples provided are for illustrative purposes only, and materials from this presentation may not be distributed without KLG's express consent. With that, let's get started. I'll now turn it over to David and Maida.
Well, thank you everybody for joining us. As Buster Poindexter said, it is hot, hot, hot out today. So we're just going to, what better place to be than a KLG webinar? So today's topic is going to be valuing closely held businesses. We're going to get into the income approach, and we're going to get a little into double dipping. So just starting with what we're going to go through, we're going to talk a little bit about Revenue Ruling 5960, which is basically our Bible. Basically, it's the framework for valuing closely held companies for estate and gift tax, and it also identifies key factors to go through. We'll talk about the valuation methods briefly. We'll talk about valuation adjustments and normalization adjustments. We'll go through the income approach to valuation, and then we will get into double dipping. So first, Internal Revenue Code Revenue Ruling 5960. As I said, it's kind of like our Bible. It's really tells us, what to do, how to value things. So essentially, it's the purpose of the ruling is to outline and review the approach, methods, and factors to be considered in valuing shares of the capital stock of closely held corporations for estate and gift tax purposes. The methods also herein will apply to the valuation of corporate stocks on which market quotes are either unavailable or such scarcity did not reflect the fair market value. So essentially what that means, it was originally done, I think it was 1959. And it was really for doing estate and gift tax work, but it's really, carried over to all closely held businesses and any stock which has very, very, very little trading. And therefore, a couple of sales would affect the price drastically. It also gets into the definition of fair market value, which is the price at which property would change hands between a willing buyer and a willing seller when the former is under any compulsion to buy and the latter is not under any compulsion to sell, with both parties basically having reasonable knowledge of all of the facts. So that's really, the definitions. You see these, especially the second one in our report all the time. But we just wanted to, kind of go through it quickly. So also Revenue Ruling 5960 outlines 8 distinct factors. We also put these in our reports: the nature of the business and history of the enterprise, the economic outlook in general, the book value of the stock and financial condition of the business, the earnings capacity of the business, the dividend paying capacity of the business, whether or not the enterprise has goodwill or intangible value, sales of stock and the size of the block to be valued, and the market price of stocks of corporations again in similar lines of businesses that are actively traded in free and open markets. So those are the 8, the 8 things that are really outlined in 5960. Now let's talk about 3 approaches to value a business briefly. The components of business value: tangible, which is, the actual assets less the liabilities, and the goodwill value. The cost approach generally used for, substantially asset-based companies, real estate holding entities, or companies with a whole lot of machinery and equipment. A construction company can be an example of that. We use the cost approach for those. The income approach, value based on a multiple of future, the keyword being future income or earnings based on the risks of the business. Basically the value of the business equal to the present value of the expected future income. And it's used primarily for operating businesses that are not asset intensive, that are making profit. And then we look at the market approach, which is value based on sales of similar businesses, either public or private. The key being that they must be comparable businesses. So what is the income approach and when to utilize it? Just briefly again, we talked about revenue ruling 5960, when the earnings capacity of business being valued is to be considered. Methods, the main methods are the capitalization of income or capitalization of cash flow method, the discounted cash flow method, and the excess earnings method, which is really a hybrid of the asset and the income approaches. Today, we're going to talk about the capitalization of income and cash flow and the excess earnings a little. We're not going to talk about the discounted cash flow too much. It's that you can have an entire webinar on that one thing. If people are interested in that, we can do that later. You'll tell us when we get into the, when we send out our thing at the end. So really the income approach to value, what is it? It's an estimate of the value of the asset or the business, the equity value, based on the income, cash flow, or EBITDA that the business is expected to generate in the future. Again, it's a future looking model. It's not based on the past. A lot of times we'll take averages of the past, but that's in order to try and figure out what the most likely future income of the business is. That's what we're trying to do, figure out the future income of the business. And then we convert the future income of the business into a present value, basically by capitalizing a rate or doing a discounted cash flow. And when we talk about a capitalization rate, we'll talk later on about how we get into that and how we do that and what goes into that. All right, Maida, you're up.
Okay, so now that we know what the income approach is, let's talk about specifically the capitalization of income or cash flow and the steps that we go through to prepare that type of evaluation. So we begin with looking at the results of the business as it's reported on its tax return. And of course, I think as most of us know, everybody's tax return is 100% reliable. And so we can just take a look at that and be done and say, okay, here's our income of the business. But of course, that's not really reality. There are any number of things that can take place in the ordinary course of business that may or may not be considered normal. And what the income approach and the capitalization of income is looking for is what are the normal operations of the business? What is the future normal operations of the business? And that's what we have to go through. We have to go through the steps to determine what that normalized operating income is. So we will be doing valuation adjustments, which we'll discuss in just a minute. And after you do all of those normalization adjustments and you come to that normalized operating income, you subtract reasonable compensation for the owners. You determine a multiple, as David just said, which is based upon the various risk factors of the business. And the most commonly used method for that is a build-up method, which we'll discuss when we go into an example of value of the income approach. And we also take a look at the normalized balance sheet. So just if you participated in our first webinar where we were talking about all of the steps leading up to the valuation, we talked about meeting with the business owners and to get an understanding of the business, to get an understanding of the owner's involvement in the business, what their roles and responsibilities are, et cetera, and to really understand the industry within which the business operates and the specifics of the business. And all of that is really important because that's what will help to drive all of the valuation adjustments that we're going to discuss in a minute. So you can go on to the next one. So again, these valuation adjustments are being made so we can determine the normalized income, operating income of the business that's expected in the future, because it's, again, valuation is a look at the future. So there are a whole slew of normalization or valuation adjustments that we will make once we have determined, to help us determine the normalized operating income. These fall into a broad base of categories. They can be one-time and non-recurring expenses. There can be discretionary expenses, non-operating income and expenses, non-cash expenses, most specifically amortization and depreciation. There can be some unreported revenue that we have to adjust for, reasonable compensation, or some non-operating assets. And now,
Let's give examples of each of them. I think
I'm
that'd be
going to do
easier.
that in a moment.
Perfect.
So now I'm going to go into more detail on each of these. So some of the examples of one-time and non-recurring expenses can be restructuring expenses. So if a business went through a restructuring process in any given year and incurred expenses related to that process, once the restructuring has occurred, most of those expenses are not going to be incurred anymore going into the future. So we will adjust for those. Similarly, legal settlements. If a company was involved in some form of litigation and incurred legal fees to negotiate or to complete that legal settlement, we will add that back to the income because that is non-recurring and not expected to happen in the future. Unless, of course, it is, in which case there are some businesses that are highly litigious and may have constant ongoing legal issues. So we may not adjust for it. Moving expenses, if a business has moved its office location, that's not something that's done on an ongoing basis. It's usually one time, non-recurring. So we will add that back to income. Any expenses associated with a discontinued operation. So earlier, David said that we will look at the historical income, and we also mentioned that we look at tax returns, typically for 5 years, as that is what's considered a normal business operating cycle. But anytime during that period, perhaps one segment of a business's operations were discontinued. And if there are expenses on the books associated with that, we will add those back because that will not be part of the ongoing operations of that business.
Right. Sorry, just to interject, Maida. The 5-year cycle is not for all businesses.
No.
It's for a majority of them. There are businesses that have longer cycles. And we would look into that. We will take that into account when doing those types of businesses.
And oftentimes we might have a startup business that has not even been existed for 5 years. So that was a good point. And you can value startup businesses as well. You don't have to have 5 years. So another non-recurring adjustment would be any type of repairs that were related to a disaster or any other kind of emergency that may have occurred within the business during the time period that we're looking at.
We saw that a lot right after Superstorm Sandy. We
Yeah.
saw a lot of those, one-time repair. So
Particularly in this region.
yes.
Not necessarily in other parts of the country, obviously. Okay, so the most common adjustments that we make are generally related to discretionary expenses. And those are the types of expenses that a business owner may put through the business that by choice, they may choose to, and typically they're also personal expenses. So travel, if a business owner puts through some personal travel expenses, we're going to add that back. Sometimes we see that a business owner will pay a family member compensation, maybe a spouse, maybe a child, or a relative, and that person doesn't work in the business. So those are definitely expenses that we would add back to income because they are not part of the ordinary business operation.
Or if they do work in the business, sometimes they're not paid fair wages. So we
Correct.
have to take that into account as well.
Beat me to that one. Personal auto expenses. Many business owners will write off their car as an auto expense and all the related gas, repairs, insurance, etc.
Goals.
Tolls, right? Oh, that's also travel, commutation, all these types of things. Personal meals and entertainment. A certain amount of meals and entertainment are acceptable for many businesses, and typically only 50% is allowable by the IRS as a tax deduction. However, many businesses will put through significantly more than would be considered normal part of the operation of that particular business. We'll see people who put personal living expenses going through, maybe the rent on their home, or there could be just renovation expenses in their home, repairs in their home, any multiple types of living expenses, and rent paid to a related company. That's an interesting one, which we'll discuss in more detail when we do show you an example. But if a business owner also owns the company that owns the space that is being utilized for the business, they may or may not be paying themselves what is considered fair market rent. So these are, you can understand why the importance of the interview with the business owner, and having seen the books and records before we do that interview, we will know what types of things are being deducted on the tax return that may or may not be part of the ordinary business expenses for that particular company. So then sometimes there are some non-operating income or expenses. I'm not going to go into a whole lot of detail because these are less frequently seen on most small, mid-sized companies. Gains or losses on the sale of an asset, bad debts, personal vehicles, boats, airplanes, real estate that may be on the balance sheet. Those we see, every now and again, which is why the importance of looking at the balance sheet, because obviously there are a few businesses that need a boat or an airplane to operate, and that may be on the books and records of the business, plus, again, as we just described, all the associated expenses for those assets that are being paid through the business. And those will all get added back to income. So again, it's the normalized operating income is what is the goal here. And these things would not be considered normal. And then the big one that is often most contested in many valuations, or can be contested in many valuations, is reasonable compensation. So according to the IRS, it is the value that would ordinarily be paid for like services by like enterprises under like circumstances. So what does that really mean? Well, again, this is why we have to really understand the nature of the business, the size of the business, the role and responsibility of the business owners, their qualifications, their experience, And it has to be what is right for that particular business. Because there can be two similar businesses in any given industry that may have a very different set of circumstances. So the level of compensation that would be considered reasonable for the owner may or may not be the same, despite the fact that they're both restaurants. Or despite the fact that they're both, XYZ manufacturing company and they manufacture similar products. So all of this has to be taken into consideration. It's part of the interview process. And so we will take a look at various databases that we subscribe to. We'll look at public information. We'll look even at, different salary.com just to get an idea. There's a whole lot of information out there that we will take a look at to make a reasonable estimate for that owner's compensation.
Right, just some other things, Maida, that we take into account. They work full-time or part-time,
Right.
or what percentage of the time they work, or, what they pay their employees. Because, if you're running a company and you're paying someone $500,000 to be a vice president, it's gonna be pretty hard to pay yourself less than that if you're truly running the company. So that's why we look at all these aspects.
Correct. And if we're valuing for example, a law firm, a partner's interest in a law firm, you may have heard us ask for the highest paid non-equity partners or non-equity, someone in the highest non-equity role, whatever that may be. It's different in every firm, so we can get a sense of what those people are paid, because that would be the number that we would use as a reasonable compensation. And when it comes to some other types of businesses, like certain medical professionals or corporate businesses, can be very tricky to determine reasonable compensation. You may have a specialized surgeon that we're valuing, and those skills may not be, a hand surgeon who's top in the world. What is the compensation, reasonable compensation for that type of person? Same thing can go for certain corporate executives who just seem to bring something to the table that other corporate executives do not, So that's one of the reasons why estimating reasonable compensation can be, is sometimes highly contested within evaluation. If you've hired, both sides have their own experts, it can be contested. And there's a lot of discussion oftentimes about that. And it's also really important in a divorce action for determination of maintenance. And that gets into the issue of double dipping, which we will get to at the end of this presentation. So here we have an example of normalized cash flow. And in this particular example, we tried to show you some of the things that we just discussed. So the top line is the revenue for the tax return. As I said earlier, we always use the tax return revenue as the the starting point, and the tax return operating income. These are our starting points for this analysis. In this particular instance, there was additional unreported revenue. So we add that back. And you'll notice that it's not only is it added back into the top here to, well, Dave, can you point to it? So that we end up with revenue for evaluation, but we also add it as an adjustment to income because it affects both parts of the analysis here. Then some of the other items that our adjustments to income section, we have officers' compensation, which we just discussed. And we can't forget to do the payroll taxes. So we want to add back any of the payroll taxes associated with that officer's compensation. One of the things I didn't mention earlier, which you'll see here, is pension and profit sharing. For a business owner, that's really just part of their compensation. So we will add that back. When we do look at pension and profit sharing, when we see that on a tax return, we will specifically inquire as to whether or not that is for solely the owners of the company, or if it includes other employees. Because if it includes other employees, we wouldn't add that back here, because we're only trying to add back the owner's pension and profit sharing. And if it is the instance where it is for all company employees or more company employees than just the owner, we'll ask for the specific amount. Typically, most firms have schedules for that. Here we're adding back rent expense, and you'll see on the next line, we're deducting fair market rent. So this was instance where a business owner was also the owner of the building from which the business was operating. And businesses don't always pay themselves fair market rent, because they're paying themselves in essence. And they can pay more or less than fair market rent. But anybody else operating in this space that didn't own the business would be paying what's presumably fair market rent. So in this, when we encounter this type of a situation, we will ask for the real estate appraisal for the business that owns the real estate. And then we will also specify that the appraisal must include an estimate of the fair market rent. It is not always an ordinary part of the real estate appraisal. So we will, if that's the situation, we will typically reach out and ask through the attorney to make sure that the real estate appraisal does include an estimate of fair market rent. Or sometimes we will reach out directly to the appraiser who prepared the real estate appraisal and obtain that information. Here, next two lines, depreciation and normalized straight line depreciation. So we add back depreciation because it's a non-cash expense that is deducted on the books and records of the business, which lowers income. That is just a tax item. And so we will add that back. But we do want to take into consideration some form of normalized straight line depreciation, because people will make tax choices when it comes to whether or not they should accelerate the depreciation. And if under normal circumstances, if it wasn't accelerated, we might want to, there's a capital expenditure item that's not in here, and we didn't really get into that detail, but you would deduct that because that's an ongoing expense of the business. And in this instance, where there was some accelerated depreciation, and then here you can see it in 2021, how much higher depreciation is than in any other year. So what we would do is we would look at what would be the normal straight line depreciation. And by doing that, we've captured the capital expenditures going forward. So that's another adjustment that we generally make. Repairs and maintenance, in this case, it was for home renovations. As we said, that's one of those discretionary items. And here there were some cash bonuses paid to the employees. So that additional revenue that was up top was probably unreported cash revenue, and some of that was used to pay the employees, and we would have to deduct that because it wasn't reported on the books and records, since it was the cash that was not reported on the books and records. This particular analysis doesn't show a tremendous amount of personal expenses. But trust me, when we go through our valuations and we do our forensic work, we look very closely to see exactly what's being deducted in that business. We often see credit card. You'll see plenty of credit cards. I mean, I actually am working on a valuation right now where there's close to $2 million of expenses deducted on credit cards. And so we have to go through we ask the parties to go through the transactions on the credit cards and tell us which ones are personal, because we know that and particularly in this instance, we know that all of those expenses are not business expenses. So that's where the forensics of our job comes into play. It can be a lot of work, but again, we want to arrive at normalized income. And that's what we have down towards the bottom. It says normalized pre-tax earnings cash flow before reasonable compensation. So we'll determine, in this case, we used a 3-year weighted average, 21, 22, and 23. Determined that the normalized compensation was 1.16 million. And through our research and understanding of the business, we came up with reasonable compensation and payroll taxes of 394,000 and normalized pre-tax earnings of 722.
Okay, so now what do we do with that number? So the next thing we do is this buildup, which you may or may not have seen. I'll gonna walk you through it. So buildup is essentially trying to figure out the risks of the company in association with public company risks and how they and small companies and how those risks are associated with those, what additional risks there are, and what somebody would essentially invest into the company in order to purchase the company. Okay, so how many years or what risk rate they would take. So the first thing we do is we look at the riskless component. Okay, that in this case is 4.2%. That's essentially a 20-year treasury bond. Okay, as of the valuation date, which is December 31st, 2023. So that is basically a risk-free rate. It's the U.S. government's backed treasury bond. So there's not any risk to that. Then we look at the equity risk premium, which is a 6.2. Now, these are all additive. So it's not that it's 6.2, it's actually 10.4, but it's 6.2 above the riskless rate. Okay. And this is essentially a large company stock, Apple, IBM, Microsoft, Dell, the really big stocks that everybody, a whole lot of us are probably all invested in. And that's what we're looking at. Then we look at a size premium, which is an additional 4.7%. And that essentially is the risk of investing in a small public company stock. So not the ones you would really, see often on the NASDAQ or on, on Dow, one of those. It would be those really much smaller ones with small capitalizations and small equity values. So that's where we start. And the reason we use these is because they're public company stocks. And we're going to talk about that later on when we talk about the tax rates. So then we look at the company specific risk premium. And this is essentially what the risks of our company are, the company we're valuing, above and beyond what a small public company stock is. So in this case, we used 7%. Most of the time, you'll see it between 3 and 5%. There are a lot of things that go into these. They include things like your competition, the size of the company in relation to the size of the small company stocks, the depth of the management, the customer base. If there's any large customers that make up a very large percentage of the sales, if there's any suppliers that make up a large percentage of your supplies and you can't just easily replace those people, things like that. I mean, we could talk about it for 15 minutes and go into all the variables and all the different ones we've seen over the years. But those are essentially the ones we see most of the time. Maybe any others you can think of off the top of your head?
I think we might consider if there's a key, if the business owner is a key person.
Right. Or if there's a key employee that doesn't have an employment agreement and is responsible for bringing in a lot of the business, things like that. So that essentially, when you add all of these numbers up, the 4.2, the 6.2, the 4.77, gives you the discount rate, which is 22.1%. Okay. From that, we then deduct the growth. In this case, it was 2%. That's the future growth of the company basically into perpetuity. A lot of the times you'll just see 3%. We look at databases for this as well, especially subject to the industry it is in. Okay, so that's what we're looking at. And that brings us to 20.1% as the cap rate. So what does the 20.1% mean? That's what somebody would essentially pay, or the rate they would use to invest in the business that we're valuing. So if you think about it, it's the inverse is a multiple. So it's very close to a 5 times multiple. So someone would pay 5 years or 5 times the normal earnings of this company based on its risk factors in order to purchase this entity at fair market value or sell this company. That's what someone value would want to sell it, because it's, fair market value is a willing buyer, willing seller. So that's what we're trying to come to, that number based upon what the risks of the specific company that you're valuing are, in order to figure out what somebody would pay. And where do we get this information? So obviously the 20-year T-bills you can find online. And then there's a database called Kroll Cost of Capital Navigator. It's changed like 10 times in the 28 years I've been doing this, or 30 years I've been doing this. The name changes all the time, but it's essentially, it's an online subscription now. We just look it up and we get it as of a certain date. So how does that work in? So let's talk about the capitalization of earnings / cash flow first. The first thing we're going to do is take our normalized pre-tax earnings. That comes from, when we did this, you'll see the 722, which is the 3-year weighted, minus the 394 of payroll, of reasonable compensation and payroll taxes. That's always going to be our starting point. Okay. From that, we deduct taxes. This was a New York City company, so we used a 35% tax rate. They're based on corporate rates. And why are we using corporate rates? Because these rates are public company stocks. So they're corporate stocks. They're basically they're paying at corporate rates. That's what you're comparing it to. So you've got to do apples to apples, not apples to oranges, which is why you're not going to use a personal tax rate, because when you're looking to compare it to this, you want to use the same tax rate that they're using. So we use the corporate tax rate. In this case, it was 35%. Normally it's somewhere around 28%, but in the city, New York City, they pay the extra tax. So we have to add that on. That's additive. We then multiply that by the growth rate that we deducted. We talked about the 2%, and that gives us the growth affected cash flow of $478,686. What do we do with that? We then take that capitalization rate, that 20.1% that we did here, was Exhibit 3 at the time. Okay. And we divide it by that cap rate to come to a 100% equity value interest, essentially, for the company before any discounts, of $2,382,000. So essentially, this business is worth $2,382,000, but then that's on a not marketable basis. So we now have to market it. We have to put it on the market to sell it. That's what we assume. We assume it's got to go on the market. So we have to, basically it takes into account time on the market, costs associated with selling, all of those things. And a 100% interest doesn't have a very large discount for lack of marketability. It's 10%. That's what we utilized. And then we deduct that from the 100% interest to get the fair market value of 100% interest on a non-marketable basis of 2,169,000. That would essentially be the fair market value of the 100% interest that's been put on the market. And that's really the number that we're looking at. That's the value of the business. Okay. We're now going to talk a little bit about the excess earnings method, which is that hybrid approach. Okay. So the first thing we do, we start with the net tangible assets. And if you remember, going back a few slides, Maida talked about doing a normalized balance sheet. This is the amount of tangible assets on that normalized balance sheet. We're not showing it here. That's a whole nother, level, and we're limited in the amount of time we can go in. But if anybody has any questions on that, they can always ask. Essentially, you're taking the normal assets of the business less the normal liabilities of the business to get to that tangible assets. In this case, $55,000. So what do we do with that? We take the normalized pre-tax earnings, which was the 1,116,000, less reasonable compensation, less the return on the tangible assets. So what we have to do then is take a reasonable return on these tangible assets. Doesn't have much effect on this one because it's only $3,000. But if these tangible assets were, say, $300,000-$400,000, then this becomes, a real number. And the reason we're doing that is because this can be invested and make money on the side. So what you're trying to do is figure out what the business value is. So because you could just invest this and make money, you've got to deduct it because you're assuming it's doing that. Okay. That gives you the pre-tax earnings of 1,112,000 times the same tax rate. Gives us after-tax excess earnings of $723,000. We use the multiple of 3 here. The reason it's different is because, first of all, you have net tangible assets. Okay, so that takes that into account. I think, Maida, did we not? I also think maybe we didn't deduct the reasonable comp from it. Yeah, we took the 1,116. This number actually should be the 722. So it's probably going to be a higher number because the 722 less the taxes. So this would probably wind up being a higher multiple, but let's just ignore that for the moment. Pretend that the pre-tax earnings were 1,116,000, gives us a goodwill value of 2,170,000, which we then add to the 55,000 to get our value of 2,225,000, which would have been close to the 2,169. But nobody's perfect, I guess. And so there we go. So that's really how we get to value. What would we do with these then? We would probably take some sort of average of the two. They're very close in number. So we take some sort of average of the two to figure out, what the number is, and that's how we would do it. So either we'd weight it 50-50, or if we thought one of them were better, we'd weight that one, higher than the other. But because they're fairly similar, we'd probably take a 50-50 weighting, and you get somewhere around, $2.2 million for the value of this company. There is no marketability discount on an excess earnings when valuing a 100% interest because it's in the multiple. So we don't do that additional. We already included in that multiple. So we don't do it, which is another reason why that multiple is slightly lower. Just, I guess, let's briefly talk about the discounted cash flow. We don't have a slide on it. As I said, it's somewhat complicated. It can be its own presentation in and of itself. But what it is you're taking the projections done by management, or some people will do their own projections, and you project those into the future until the company is essentially a stable company. And when you get the stable company, then you're going to have what we call a terminal year, which is the year in which stability occurs. And then you're going to present value each of those years' cash flows back based upon the risks of the company, which would be based upon back upon this buildup that we saw here. So you take the risks based on these risks here, and this capitalization and this discount rate. Okay, the capitalization rate would be used in the terminal year. The discount rate's used in the other years. Again, it's somewhat complicated. And then, you know, there's debt issues you have to get into if there is debt on the books. And then, you know, it becomes very complicated because then you might have a weighted average cost of capital. Again, it's a whole another complicated thing, which is why we didn't want to get into it all, because we didn't want everybody's presentation to last 2 hours, although it's 130 degrees outside. So, you know, nobody really wants to be outside anyway. But, you know, that's really the income approach to value. Let's talk a little bit about double dipping here. And maybe you can chime in whenever you want on this one. But basically, double dipping is the earnings above reasonable compensation, but below the normalized income that gives rise to the goodwill value. So essentially what's available for maintenance and child support. So the reasonable compensation in the case that we did of 394, all of that income would be income available to determine maintenance. Okay. It was not utilized in our valuation. If you remember, okay, going back a few slides, we subtracted it out from the 1,116,000. Okay. So that 394 was not used in our valuation. So therefore that makes it available to determine maintenance, child support. Anything above that from the 394 to the 1,116,000, that was utilized in our, you know, value. So we don't do professional practices really anymore. Professional practices we do. Sorry, we don't do EECs anymore. I apologize. So that's the income used to value the business or the professional practice. That is no longer available because it's utilized in our valuation. I know there's case law out there that says you can take percentages of it, you can utilize it. There is no double dipping. Whatever state you're in, there's very different things. But the way we look at it, and you know, the way I know a lot of people do is this number, the 116 minus the 394, which was I believe 722, if I remember correctly. Was it right? 722, Maida?
That's right.
Okay, that was all the income that was used to value the business, how we got to the $2.2 million number. So we don't want to use that same income stream a second time. So it's no longer available for maintenance. We always thought this was a good way to look at it because it kind of breaks it, you know, breaks it off. This shows what's available. This shows what's not available. And then if somebody starts making a lot of money, you know, if it's say a 2021 action for whatever reason, and now you're, you know, 2024 comes around and they're making say $1.4 million, the money above that, what was used to value the company and what they're making now, there could be a claim, I guess, that is available for maintenance as well. I know these numbers are higher than the caps in New York and Connecticut and in most states. We didn't really want to get into all of that, you know, based on the caps and all that. But this was essentially, this is essentially double dipping and the way it's looked at and the way we look at it. So, Sammy, do we have any questions?
Not at this time, no.
Okay. Well, that's pretty much our presentation on the income approach and double dipping and normalization adjustments. You know, you guys, a lot of you know us, but just quickly about us. You know, we do business valuation, forensic accounting, litigation support, you know, for matrimonials, estate and trust work, pretty much the whole gamut, corporate dissolutions. We do mediation and collaborative work as well. So if you guys have any questions or you want to contact us, you can call myself or Maida at any time or email us and we'll get back to you. And thank you for joining us, and try and stay
Thank you.
cool
Stay cool. Stay
try and
hydrated.
stay cool and hydrated on this hot day. All right. Thank you, everybody.
Thank you.